Okay? So this is the Comprehensive Tax Reform Program, and this is package 2 of about 5 tax reform packages that this administration is hoping to pass pretty soon, or as our hope, hopefully before the end of the year. Okay, let me begin. So what am I going to talk to you about this afternoon? First, where are we right now? So that's the background. And then why are we doing the reform and what these reforms are all together. We've heard a lot of worry coming from the sectors involved, the locators. In fact, this is already my 3rd time to be here in Clark. Earlier this year, I was here, similarly in Quest, talking about package 2. And at that, during that time, I was in an audience where all the tables had apples for each of the participants. And immediately I told them that to keep those apples away from me because, you know, being hit by apples is not very pleasant. So anyway, so where are we? Right now we have, this is the corporate income tax regime. As you very well know, all corporations, if they're not in a special economic zone, pay the 30% net, 30% of their net taxable income as tax. Even non-resident foreign corporations pay the same amount. We also have a 2% gross minimum MCIT and an optional standard deduction of 40%. The other speakers have also pointed this out, that compared to our ASEAN neighbors, we are top in terms of the nominal tax rate. So we're the highest, we're at 30%. Okay. Now, in terms of the investment incentive system, we have a fairly elaborate incentive system because we have 14 investment promotion agencies. The BOI, I think, is the oldest of these investment promotion agencies, followed by the PEZA, and there are 12 other special economic zone authorities, including here in Clark. And all of these 14 different agencies are authorized by law, by their charters, to provide fiscal incentives. Okay. Other than that, we also have 123 investment laws, 3 of which are provisions of the National Internal Revenue Code, and there are other laws that have been legislated by Congress, aside from 192 non-investment related laws that also provide fiscal incentives. At the centerpiece of most of these fiscal incentive packages is the income tax holiday, followed by the 5% gross income earned. I think this is the most favored among the investors, the FDI, and also the customs duty exemption. So right now, based on our studies, the GIE seems to be given indefinitely. In Tagalog, siya yung may forever, no? May forever yung GIE, especially for those which are located in PEZA zones. And the GIE, as you very well know, is in lieu of income, VAT, and local taxes. Now, since 2015, we've had the advantage of having in place the TIMTA law, which allowed us to get information on tax incentives that are being granted by the registered investments. Okay, now we also have the Investment Priorities Plan, and this is the one that is administered by the BOI, and it has been in place for the last 50 years. So it started in 1968. So we've had 50 years of picking winners through the Investment Priorities Program. Okay. These are the logo of the 14 investment promotion agencies. They're quite colorful when you look at it in the slide. Very nice to look at. This is also where you can find the National Internal Revenue Code and the other exemptions that are provided. Okay. Now, the 123 investment-related fiscal incentive laws by sector This is the breakdown. You can see that there's a lot of sectors that are covered by investment incentives. Many of which right now, there's communication and postal services. There are 42 laws which provide incentives for this sector. So for agriculture and agrarian reform, there are 8 laws. Okay. Jewelry, we have 1 law. Micro, small, and medium, there are 2 laws. Various sectors under BOI 4, so we have this. Okay. Now, in terms of comparing incentives across ASEAN, we think that we are among the most generous, if not the most. Of course, the data that was presented earlier seems to indicate otherwise, but I'm the one presenting, so this is our point of view. The Philippines is, in terms of the income tax holiday, you have a 4 years plus 8 years of extension, and then you have a GIE, which seems to last forever. The other countries have maximum period with which they provide the income tax holiday. Okay. We also have other incentives provided by law. We have tax investment allowances, the higher deductions for R&D, training labor, accelerated depreciation, the NOLCO, customs duty exemption, and some export subsidies. Now, how do we compare the corporate income tax revenue? It's been rising as the economy is rising because corporate income taxes are very buoyant when it comes to the growth of the economy. When the economy grows, we see an increase in the collections from the CIT. And we forecast that it will grow even faster as the economy also grows even faster as we approach 2022. So right now, the tax to CIT revenue to GDP ratio is around 3.6, 3.7% in 2016. Okay. However, our revenue efficiency, which is revenue productivity, calculated as the ratio of the tax revenue as a share of GDP divided by the tax rate, we are not very well situated. Because while we have the highest headline revenue in headline tax rate in ASEAN at 30, our revenue productivity in 2016 is only 12.3% compared to Thailand, which has a CIT rate of 20, but the percent of GDP of their CIT revenues is 4, so the revenue productivity is 20.1. Vietnam is even more better situated because as a percent of GDP, their collections of corporate income taxes are at 7.1, and their headline rate is only 20%. So the revenue productivity is around 35.6%. Okay. Okay. So this is a fairly controversial topic, so I would suggest that you all sit back and enjoy. Thank you. Okay. This is based on the TIMTA, submissions to the BIR of all the registered investors. So this is what we computed. Now, 301.2 billion includes the VAT, which of course we will not count because that's a consumption tax, so it nets out in the process. But in terms of income tax, we're counting 86.3 billion, 18.1 billion for customs duties, and there are no estimates for the local business taxes which are forgone. We do not have data for that, and the TIMTA does not provide for the submission of this information from the investors. Okay. Previous to the TIMTA, we also did our own estimation of revenue forgone. And why did we do this? Because we've been trying to push the rationalization of fiscal incentives from 20 years ago, from 1997. We've been trying to do this, and even much earlier, I think it was 1995, this was already part of our tax reform proposals. So we've been having a series of studies trying to estimate how much does it cost the government when we grant the incentives, or how much revenue for GAN is there. So this is our estimation of that. Now take note that as a ratio to GDP, the estimate of tax incentives has been going down from 1.5 in 2011 to around 1% in 2014. And this is largely due to the fact that customs duties as a whole has been going down because of our free trade agreement. So that portion of our revenue for GAN has been going down. Okay. Now this is, again, from the Team Talo. This is what we're looking at. And take a look at this. As a ratio of GDP, that's the bottom line, from income taxes and also from customs duties, the ratio to GDP is even lower now to 0.8%. And this is what we are interested in looking at, because this is going to be part of the reform that we're pushing. Okay. Now, in terms of which IPA, or Investment Promotion Agency, is giving the most, it's PEZA. In terms of tax expenditures, about 66.6 billion pesos has been provided by PEZA, followed by the BOI, 29.4 billion. Clark is not as quite as generous, 4.1 billion. No? So thank you. SBMA, 3. Okay, 3 billion. So which sectors are the top beneficiaries of incentives in 2015? We see here manufacturing sector, industrial goods, machineries, electronics, and electrical products. And the services, the call centers and the BPOs. Now, because of tax incentives, we find that tax rates are very unequal. For a corporation that's basically probably doing the same thing, it matters for their effective tax rate whether they are located in a zone or they're not. If they are a recipient of tax incentives, for example, their effective tax rates ranges from 6.3 to about 12 or 14%, which is just 1/3 of the effective tax rate of regular firms, because regular firms pay income tax at 30%. So this is across all sectors. In terms of value-added tax, this is what we are seeing. Okay. Okay. The benefits. We also measure the benefits that can be attributed to having an investment incentive system. And one of these is that we have noted that foreign direct investments to the Philippines has been growing, and that in 2016, we reached already net FDI flows of $8 billion. Okay. However, if you again compare that to our neighbors, we can do better. Malaysia, for example, is getting 13.5 billion. Vietnam is getting 12.6 billion. And we will not even speak about Singapore. Okay. Now, if we talk about percent of GDP, and we note that there are also, I note that the same information was also presented earlier, no? In terms of, for example, Cambodia being a small country, but in terms of the flows going to Cambodia, it's 9.4% of their GDP, whereas the Philippines is just 2% of GDP. And take note that the Philippines has a bigger economy than Cambodia, or even, well, Vietnam. Let's just look at Vietnam. It's 6.1% of GDP. We almost have the same size of economy as Vietnam at this point. We might be even bigger than Vietnam. But Vietnam is attracting investments in the proportion of 6.1% of their GDP, whereas we're just getting 2% of our GDP. Okay, so at this point, we see that foreign direct investment, the flows, we're recording them to be very, very high. So that's the data from the first quarter. So it rose, the flows, we're talking about the flows, rose by 43.5% in the first quarter. And this is despite the news that the pledges dropped by 37.9% in the first quarter. Now, is there any link to the flows and to the pledges? And we took a quick look at how it has worked out in the past. And we see that it seems that the first quarter approved investments generally peak during election years. Now, what are the election years here? Those are the bars that are colored purple. And take note that it was, in fact, in 2004 when we registered the very, very high approval of foreign investment or pledges. That's about 119 billion pesos of pledges was approved in 2004. But since 2004, pledges have been going down, in fact. So, and this is even before we proposed Package 2. So, you can see here that approved foreign investments every first quarter for the past, well, almost 18 years have actually been going down or fluctuating, going up and going down. Okay. Now, in terms of competitiveness, we have seen how manufacturing export competitiveness has been declining over the last, well, this is from 2000 to 2016, so 16 years. The red bar is percent of GDP, the export of goods. The blue line is in nominal terms. So our exports have been going up, but in terms of competitiveness as a percent of GDP, it has been declining. So the export sector's contribution to the growth of the economy has been declining over time. And this is despite the fact that, well, there's another slide here which shows the BPO exports which have been increasing over time. But the increase of exports of BPO, not only nominally, but also as a percent of GDP, is not enough to counter the fall of overall exports as a share of GDP. So this implies a loss of competitiveness for our Philippine exports. In fact, the Philippines has one of the lowest share of exports to GDP. The Philippines is the broken black line. Now take note where it is in 2000, and that the red line, we were at the same point at the time, the red line corresponds to Vietnam. Now, over the years, the path of Vietnam and the Philippines did not converge, but separated. Unfortunately, the separation came at the cost of the competitiveness of the Philippines because Vietnam's exports as a share of GDP has been going up over time, while ours has been going down. Similarly, while our labor productivity, real labor productivity has been growing, it seems that our real wages have been stagnant. So that also shows that we are probably not paying enough, or the jobs that are being offered to the economy are those which do not pay as much. So while real labor productivity has been going down, our real average wage has been stagnant. It's not been going up as well. Okay. Now, I saw this slide also earlier, no? And there was also another result of the survey that was shown by the first speaker. Now, I think this is very important because we at the DOF, we're not saying that incentives are not working or are not important. We, in fact, are not saying that we should do away with incentives. That is not our position. But our point is that incentives are not the only thing which would invite investors to come to the Philippines. When you take a good look at this, you could see that the number one problem that they encounter, that they see as a problem in the Philippines, is the bureaucracy. The bureaucracy is either inefficient, ineffective, corrupt, unimaginative. And that's all. So, in fact, it's us, or me, because I represent government here, which is the chief problem. It's either we regulate too much or we do not regulate at all. Our ease of doing business could be better. The number of steps that each business has to face when they want to open a business, when they want to expand a business, the number of steps could be shorter, could be less than what it is right now. So that's the number one problem, and we recognize that. The next is infrastructure. There was a point in the welcome note of the GM of Quest Hotel this morning when he said that there are many more people coming to Clark right now because, and I've heard it also, table discussion, there's no congestion. There's a lot of greenery, which if you compare it to Manila, is really not at all attractive. Manila is not very attractive if you're on the lookout. Mr. Alexander also pointed out that when they were looking for places where to expand their operations, they looked at Cebu, they looked at Clark, they chose Clark because Cebu is congested. So the point is, that Cebu does not have any incentive. If you're in an export zone in Cebu, you will enjoy incentives. If Clark were as congested as Manila, if the traffic in the airport, if your plane cannot land and will be on a holding pattern for 30 minutes or so, if your travel from the airport to your place of work is at the least traveling at 30 minutes for 5 kilometers or so, I don't think Clark will be as attractive as it is right now, even if we give the most generous of incentives. So I think that's the point that we need to think about. And that's where we're coming from. Yes, incentives are important. Yes, they do matter. But in the overall scheme of things, there are other things which matter more, and for which we need also to do something more significant. Okay. So, yeah, that's 301 billion, and you said take away the VAT, it's still 100+ billion. It's not a drop in the bucket. There are many more projects that can be financed for 150, 130 billion pesos worth. So that's how much it was worth in 2015. Now, the initial cost-benefit analysis that we did at the OF shows that on the average, there's no difference between the performance of firms receiving incentives and firms not receiving incentives in terms of job generation, producing exports, attracting investments, and also in terms of productivity. So in some sense, or in some sectors, not all sectors definitely, certain incentives may be redundant. There are also companies, there are also firms which have reported that pay more dividends than the incentives that they receive. So we see this as a sign of profitability. And profit is good. Profit is very good. And my time is up. Can I be allowed 3 more minutes to wind up? Thank you. Thank you. Okay. So what is our reform? So these are already the bills that are pending in the House. We've started the hearings for this already. Okay. Okay, so those are the bills. Oops. Wait. Okay. So what we want to do with the corporate income tax rate, we want to lower it to 25% gradually over time, conditional on a reduction in the incentives package from 2 years ago, 0.15%. So from 0.8, it should go down. We also want one single menu for all investment promotion agencies. The FIRB will be the overall administrator of IPAs, the DOF to chair the FIRB and co-chair all the IPAs. The Secretary of Finance to have veto power also, and a repeal of 123 laws. So that's basically the bill of Congresswoman Swan Singh. Okay. These are also going to be included there, enhancing the e-invoicing system, e-sales reporting. Okay. We also want to improve compliance by simplifying tax rules for corporations. Now, on the incentive reform, these are the 4 principles: performance-based, targeted, time-bound, and transparent. So performance-based, we want clear commitments about what a firm wishes to do in the Philippines when it comes in. Does it, how much investments are they going to put in? What are they introducing new technologies? What are they trying to, what kind of activity would mean in terms of research and development, for example? Or are they locating in a province to promote its, in Marawi, for example, if they're doing that? It has to be targeted, so you know who you are giving it to. It needs to follow our priorities, which should be spelled out in a strategic investment priority plan. And time-bound, there should always be a sunset provision. The monitoring of these incentives must also be transparent and should be institutionalized. Okay. So this, I already mentioned this. The FIRB function will be expanded. This is the broadening of the tax base because we want to repeal 123 special laws on investment tax incentives to consolidate them into one single omnibus incentive law. Okay. One single menu of incentives applicable to all IPAs, no double registration, a stricter definition of what an exporter is, and domestic firms can also avail of incentives if they're part of the strategic investment priority plan. And 1 year relocation incentive for firms moving out of Mega Manila, and superior incentives for lagging regions, conflict and calamity-stricken region. So this is the proposed incentive menu. You still have the ITH. We are replacing the GIE with a 15% based on net taxable income. Other income-based incentives will be there also. The investment tax allowance, double deduction for research. The duty exemption will also remain. No more VAT incentives. The VAT is a consumption tax. Unless you're an exporter, when you don't, you're zero rated for your export. Okay. Now the LGU, we're not saying because we're moving from the GIE to the 15%. It's simply because the national government should not be committing this. The LGU can, in fact, determine whether it wants to provide the incentive. And I know the difficulties of doing that in terms of the firms having to deal with the LGUs. And that in itself is a governance issue. That is also where the different IPAs should do the role of facilitation. And we are not taking that away from them. Okay, so this is a transitory provision. Existing income tax holidays will be allowed to continue. The existing GIE will be allowed for 2 to 5 more years as a transition period. Okay. Now, this is the number of firms registered with tax incentives which have been enjoying incentives for at least 15 years. Okay. So there's quite a lot of them. We've played the host to about 654 companies and given them incentives for at least 15 years. Now, the BOI is also to formulate the 3-year strategic investment priorities plan. Okay. And that's all. Thank you very much.